Hello everyone and welcome to this new video where I will be sharing what I learned regarding the implied volatility grid, smile and skew. So in trading we know that the past is not relevant or does not represent the future. So to understand how the market anticipates the future, we look at the options market to study the anatomy of implied volatility and the shape of market risk. When we piece together the clues from option prices, we get a living, dynamic 3D map of the market's expectations known as the volatility surface. So to understand the options, we must separate yesterday's weather from tomorrow's storm. Realized volatility relies on historical histograms to measure past variance. It is perfectly accurate but offers low trading utility. On the other hand, the implied volatility, it's like forecasting a future storm. Is the market's forecast of future turbulence. It is unobservable, highly subjective, and highly valuable. So, in the pure black Scholes framework, stock returns follow a perfect log normal distribution. The model operates on the assumption that volatility remains constant regardless of the strike price or time to expiration. If the theoretical model perfectly mirrored the reality, the volatility curve would be perfectly flat horizontal line, since we said that we assume that volatility remains constant. On Black Monday on October 1987, the S&P 500 crashed by over 20% because at the time the daily volatility prior to the crash was only 0.78%. The crash represented the 26 sigma event, which is a mathematical impossibility under strict normal distribution models. The market immediately realized that extreme tail risks exist, marking the death of flat volatility assumption. This flat volatility assumption. The reality is that the stock distributions have tails, meaning the market prices in a higher probability of extreme events than normal distribution allows. This positive excess curtices proves that catastrophic crashes and windfall surges happen more frequently than theoretical models predict. And because of these fat tail risks, implied volatility increases as option moves further out of the money or in the money, creating a shaped curve. So traders are willing to overpay for deep out of the money puts as insurance policies against disasters, and deep out of the money calls as lottery tickets for rare surges. So in equity markets, the fear of a sudden crash drastically outweighs the greed of the sudden surge because equity markets are inherently long. This negative skewness creates the volatility smirk. It's like a smirk. The demand for left tail downside protection forces the implied volatility of out of the money puts significantly higher than the equivalent out of the money calls. The market's perception of risk is not static over time. Short-dated options may exhibit massive volatility spikes around known catalysts like earning reports, while longer-dated options bake in slow-moving macroeconomic uncertainty. This adds another axis that's called the z-axis, forming the term structure of the volatility. So, combining the strike price, time to expiration, and the implied volatility reveals this 3D map. This volatility surface is the true shape of the market, functioning as a living, breathing matrix of aggregate fear, speculation, and expected variance. The options pricing model acts as an engine. Quants feeds it 5 variables: the stock price, strike price, time to expiration, risk-free rate, volatility. Once these 5 inputs are passed in, the engine outputs the theoretical option price. So 4 of these inputs are instantly verifiable on any trading terminal, but volatility is the only unobservable variable because it must be estimated. It creates disagreement among market participants. This disagreement acts as the unobservable ghost and is the source of all options trading opportunity. So, this is what we just said. The market constantly broadcasts the true price of every option being traded by feeding the observable inputs in the formula. The algorithm solves for the missing variable. So if we have these 4 and this, we can know this. The output of this inversion is the implied volatility. However, American options require complex pricing models like binomial trees, multi-curve simulations to account for the early exercise flexibility. However, despite the heavier math, the fundamental principle holds. It's exactly the same. We plug in the market price to backsolve for the implied volatility. To see how backsolving builds the volatility surface in real time, let's look at the mathematical example constructing a grid. We isolate a single expiration date for the Nasdaq 500, currently trading at the spot price of 20,000. We start by mapping the baseline at the 20,000 strike, which is at the money. The market price of this at the money option, when inverted through our pricing machine, reveals an implied volatility of exactly 20%. Next, we look at an out of the money put option at let's say 19,000 strike. The investors are aggressively bidding up the premium to hedge against 1,000 point drop. This high market price forces the back-solved implied volatility up to 25%. On the other hand, if you look at an out-of-the-money call of the same underlying at the 21,000 strike, demand for upside speculation is muted compared to this downside hedging because we said the market is inherently long. The lower premium paid for this option results in a back-solved implied volatility of just 18%. So if we connect the dots, across the option chain, the theoretical concepts become an empirical reality. The Nasdaq 100 exhibits a pronounced volatility smirk, mathematically proving the market's bias toward the left-tailed risk. So the volatility surface allows quants and traders to identify local volatility anomalies to spot potential mispricing. When an option's implied volatility spikes above or dips below the expected curvature of the surface, it flags a structural arbitrage opportunity. So implied volatility is not just a mathematical output, but the practice of reading between the lines to uncover what the market believes but cannot directly see. Predicting the evolution of the surface is the ultimate structural edge in options trading. Now let's look at this Jupyter notebook where we will construct and visualize a synthetic 3D implied volatility surface, the same kind of the volatility matrix that option traders and risk managers use daily to read the market's aggregate fear and expected variance. Rather than back solving the Black-Scholes model with live options data, we will synthesize a mathematically realistic implied volatility surface from the scratch. So we will encode the volatility skew or smirk and the term structure, where the implied volatility is not flat across time. Near term implied volatility can spike around events, for example earning event, while the longer dated implied volatility reflects macro uncertainty. So let's build it step by step, starting with the libraries. Now we will define the x and y axis. The x-axis is the strike price. We define strikes relative to hypothetical spot price of 100. So at the money equals 100. The range spans from deep out of the money puts 70 to deep out of the money calls 130. Covering the full swings of the options chain. And for the y-axis, it's the time to expiration. We'll express it in years, ranging from the near term, so 1 week is 002 years to 2 years. So every cell represents a strike and expiry. Let's do that. And now we synthesize the implied volatility. This is the core of the notebook. We will build a single formula that encodes the two real-world implied volatility behaviors simultaneously. So volatility skew across strikes. The implied volatility forms a parabola across strikes, but it is deliberately asymmetric. The left wing is evaluated far more than the right wing, because as we said, the market is more afraid of the or the market is inherently long. So yeah, the longer longer dated options carry more macro events uncertainty, so IV gently slopes upward with time. So on top of this, we add the near-term spike to simulate imminent event risks like an earning release that would inflate the short-dated implied volatility before reverting. Let's do that. So, and now we will just plot it. This is what we expected. This is the smirk. as you can see right here, and this represents the earnings risk that we talked about. So if we see the interpretation, there is the smirk, the left swing strike at 70 carries almost 32% of implied volatility versus the 18% at strike of 130. So it's like this. This is the shape of the smirk. The surface clearly leans left, confirming the equity put skew. The market prices downside crash protection at a significant premium over the out of the money calls, and the term structure, the back slope, where implied volatility rises gently as you move from front to back along the time axis, because longer dated options are pricier because the macro uncertainty. And the event spike, this is the event spike. The sharp fold at the very front of the surface is the simulated earning bump that we talked about. The near-term implied volatility is locally inflated before reverting. So we see that it reverts exactly how a real volatility surface behaves ahead of a known catalyst. The at the money around strike of 100 sits at its lowest. It's a bit difficult to see because it's 3D, but it's the lowest here, which is the most efficiently priced region of the surface, where supply and demand are the most balanced. So that's it for this video. If you liked it, please subscribe to the channel.